I warned you. I told you not to chase the top at 5,600. I told you the banks were setting the trap. I told you they'd come for your stop losses. And yesterday, January 30th, at 12:30 p.m. Eastern, the trap was sprung. They smashed gold to $48.86. They smashed silver to $76.02. They wanted your metal cheap. And if you panicked, if you sold, they got it. But look at the chart this morning. Silver's back at $112. That wasn't a crash. That was a robbery. And the forensic data I'm about to show you proves exactly who pulled the trigger, how they did it, and who bought the blood while you were running for the exits. Welcome to John A.G. Live. I'm your host, and today we're going to dissect the greatest stop-loss hunt in precious metals history. Let's start with what happened. Wednesday, January 29th. Gold touches an all-time high of $56.08 per ounce. Silver peaks at $121.64. The market is euphoric. Retail is all in. Leverage positions are stretched to what one analyst called preposterous levels. Then the setup begins. Thursday night into Friday morning, whispers start circulating. President Trump is going to nominate someone to replace Jerome Powell as Fed chair. The name leaking out? Kevin Warsh, former Fed governor from 2006 to 2011. Known hawk, voted against quantitative easing, wants to normalize rates. Friday morning, January 30th, 9:30 a.m. Eastern. Markets open. Gold is already showing weakness. Profit-taking accelerates. By mid-morning, gold breaches the 5,400 support level. That's the line in the sand. Once that breaks, the algorithms kick in. Cascading stop-loss orders. Automated liquidations. Margin calls. 12:30 p.m. Eastern. The White House makes it official. Kevin Warsh is the nominee for Fed chair. The market interprets this as the end of the debasement trade. The dollar index surges 0.8%, and the selling pressure that was already building, it turns into a stampede. Gold crashes through 5,200, then 51, then 5,000. In European trading hours and early US session, gold hits an intraday low of 49.41. Then it keeps falling. The final bottom? $48.86.71. Just $87 away from 4,800. Silver? Even worse. From $121.64 at the peak to $76.02 at the bottom. A 37.5% decline in less than 48 hours. Now here's what you need to understand. This wasn't a fat finger error. This wasn't some rogue algorithm. This was a coordinated liquidation event that exploited three critical factors. Number one, extreme leverage. The market was incredibly crowded on the long side. Everyone was long. Everyone was leveraged. Everyone had the same stops. Number two, month-end positioning. January 30th was the final trading day of the month. Liquidity always thins at month-end. When liquidity thins, price moves get exaggerated. Volatility explodes. Number three, the news catalyst. The Kevin Warsh nomination gave the banks the perfect cover story to dump the price. It's hawkish Fed policy. It's dollar strength. It's the end of easy money. But that's the narrative they sold you. The reality? They used that news to trigger your stops, liquidate your positions, and buy your metal at a 40% discount. How do I know? The data doesn't lie. Let's talk open interest. COMEX Gold Futures. Week of January 20th, 528,004 contracts. Week of January 27th, 488,463 contracts. That's a drop of 39,541 contracts. 7.49%. What does that tell you? Weak longs were liquidated. Shaken out. Gone. Silver? Even more violent. Over $1.68 billion in leverage positions liquidated on January 30th alone. And get this, 93% of those liquidations were from long bets. Retail got annihilated. But here's where it gets interesting. Let's talk about volume. Because while retail was panic selling, someone was buying. And they were buying big. CME metals segment. Silver, gold, platinum, palladium, copper. January 26th. When silver first hit 117, the complex traded 3.4 million contracts. The one-month average daily volume exploded to nearly 2 million contracts. On Hyperliquid, the silver perpetual contract did $4.5 billion in trading volume during January. Open interest sat at $152.4 million with funding rates near neutral. Translation? Massive institutional absorption at the lows. Volume spikes exactly when prices hit the bottom. That's not panic. That's accumulation. Now let's look at the ETFs. Because this is where the divergence becomes crystal clear. GLD, the SBDR Gold Shares ETF. Week ending January 23rd, 174.73 million in inflows. Week ending January 28th, an estimated 1.4 billion inflow. 0.8% increase week over week. But on crash day, January 30th, GLD experienced its worst day since 2006. -9 Z-score move. Institutions were selling into the crash. SLV, the iShares Silver Trust. January 27th, retail investors net bought $171 million. Nearly double the previous one-day record of $93 million during the 2021 silver squeeze. Trading volume hit 11 times the normal rate. Daily notional trades? $35 billion. Retail was buying the top. Institutions were selling into strength. Then crash day hits. SLV experiences its worst day since 2006. -13 Z-score move. Silver ETFs reduced holdings by 5.1 million troy ounces on the crash day alone. Fifth consecutive day of outflows. Total net sales year to date, 29 million ounces. You see the pattern? Retail bought the euphoria. Institutions sold the strength. Then when the crash came, retail panic sold the lows. And institutions? They were the ones with the buy orders waiting at $76. Before I continue, I need to stop and address my community directly. Because most channels right now are crying about the crash. They're telling you the bull market is over. They're saying precious metals are done. But my viewers? My viewers were waiting for this. I want to know who held the line. If you've been subscribed to this channel for more than a month, you knew this shakeout was coming. You didn't sell. You bought. If you are a true veteran of this channel, if you've been with me through the noise, through the hype, through the manipulation, go to the comments right now and type John AG Live OG. I want to see the names of the people who survived the crash. I want to see who was paying attention when I warned you in December that they'd come for your stops. I want to see who understood that a 40% flash crash in silver during thin month-end liquidity wasn't the end of the bull market. It was the fuel for the next leg. Sound off now. John AG Live OG. Let me see you. Because here's what separates you from the masses. You understood the game. You knew that every bull market has these moments. You knew that the banks don't accumulate at all-time highs. They accumulate when blood is in the streets. They accumulate when retail is puking positions at any price. And on January 30th, at $76 silver and $48.86 gold, the streets were flooded. Now let's get forensic. Let's talk about exactly how they pulled this off. The trigger was Kevin Warsh, but the mechanism was the liquidity trap. Here's how it works. Gold breaches 5,400. That's a technical level. Stops are clustered just below that. Once it breaks, automated algorithms execute sell orders. Those sell orders push the price lower. That triggers more stops, more selling, more stops. It's a cascade. And because it's January 30th, the last trading day of the month, liquidity is already thin. When liquidity is thin, every sell order has an outsized impact on price. You don't need massive volume to move the market. You just need the right timing. The banks knew this. They've been doing this for decades. They wait for a news event, something that gives them cover, a Fed announcement, geopolitical tension, a policy shift. Then they use that event to trigger the cascade. In this case, the Kevin Warsh nomination was the cover. The narrative they pushed was simple. Warsh is hawkish. Hawkish Fed means higher rates. Higher rates mean stronger dollar. Stronger dollar means weaker gold and silver. But that narrative doesn't explain a 37% crash in silver in 48 hours. That narrative doesn't explain why silver hit $76 when the structural deficit in silver has never been worse. That narrative doesn't explain why Samsung just signed a $7 million deal for silver cathodes for their solid-state battery production. The narrative was the excuse. The reality was the shakeout. And the open interest data proves it. 39,541 gold contracts wiped out. 1.68 billion in silver liquidations. 93% from longs. They didn't sell real metal. They liquidated paper contracts to force you to sell real metal. Think about that. The banks don't own physical silver sitting in vaults. They own paper, futures contracts, derivatives. When they dump those contracts, they push the paper price down. And when the paper price crashes, retail investors who own physical metal panic. They think their metal is worthless. They sell. And who's on the other side of that trade? The same banks that just dumped the paper. This is the crime. This is the manipulation. They use paper to steal physical. Now let's talk about the recovery, because this is where the data gets really interesting. Gold. Intraday low January 30th, 48.8671. Current price January 31st, 49.0285. Recovery? $16.14. 0.33%. Gold is flat, barely moved off the lows. Silver. Intraday low January 30th, $76.02. Current price January 31st, 112.46. Recovery? $36.44. 47.9%. Silver has surged 48% from the crash low in under 24 hours. Let me say that again. Silver bounced 48% in one day. That is not normal price action. That is a coiled spring. That is a market that was overcompressed by forced liquidations and snapped back violently the moment the pressure released. Why did silver bounce faster than gold? Because silver was oversold harder. The gold to silver ratio at the peak on January 29th was 46.79 to 1. Gold at 55.23. Silver at 118. At the crash bottom on January 30th, the ratio spiked to 64.28 to 1. Gold at 48.86. Silver at 76. That's a 17-point widening of the ratio in less than 48 hours. Silver was punished disproportionately. That's classic shakeout behavior, hammering the more volatile asset to trigger maximum panic. But now, January 31st, the ratio has compressed to 43.6 to 1. Gold at 49.02. Silver at 112. The ratio is now below the pre-crash level of 46.79. Silver isn't just recovering. It's outperforming. And that tells you everything you need to know about what happened. This wasn't a structural breakdown in the silver market. This was a technical liquidation event. Weak hands were shaken out at extremes. And the moment they were gone, the real buyers stepped in. Now here's where the Samsung deal and the China export ban come into play. Because while the banks were engineering the crash, the fundamentals haven't changed. Samsung signed a $7 million deal for 5,002 tons of silver cathodes. That silver is going into solid-state battery production. That silver is being consumed. It's not coming back to the market. China banned exports of critical metals. That includes silver. That tightens global supply even further. At $76, silver became what one analyst called unobtainium. You can't produce electronics at that price. You can't manufacture solar panels. You can't build batteries. The industrial demand floor for silver is somewhere north of $80 in this environment. So when silver hit 76, it didn't stay there. It couldn't stay there. Because at that price, you'd have a bidding war among industrial users desperate for supply. That's why the bounce was so violent. The market realized immediately that 76 was unsustainable. And the institutions that had been waiting for the shakeout, they bought everything retail dumped. Samsung and China didn't cause the recovery, but they set the floor. They created the safety net that made the violent V-shape possible. And that's the critical insight here. The crash was technical. The recovery is fundamental. Let me show you one more piece of evidence. ETF flows post-crash. Gold ETFs. Week ending January 28th, 1.4 billion in inflows. Even after the crash, institutional money was still flowing into gold ETFs through the end of the month. They were buying the dip. Silver ETFs. 5.1 million troy ounces of outflows on crash day. 29 million ounces of net sales year to date. Retail is selling. Institutions are accumulating. You see the divergence? Retail owns ETFs. When retail panics, ETFs see outflows. But when ETFs see outflows, that silver has to go somewhere. And where does it go? Into the hands of the institutions who are buying physical at spot prices 40% below the peak. This is wealth transfer in real time. Now let's talk about what happens next. Because the crash is over. The weak hands are gone. The leverage is flushed. The banks have reloaded. Look at the open interest again. Gold down 7.49%. Silver liquidations wiped out 1.68 billion in positions. That's dead weight removed from the market. That's the fuel for the next move. When you clear out weak longs, You create room for the next leg up. Because those weak longs, they're the ones who sell into strength. They're the ones who take profits early. They're the ones who cap rallies. But now they're gone. Liquidated at 76. Shaken out at 48.86. The only people left holding positions are the ones who understand the fundamentals. The ones who know that silver supply deficits are structural. The ones who know that gold is repricing in a world where central banks are buying 550 tons in a single year. Poland just added 12 tons in November. Their reserves are at 543 tons. Their target? 700 tons by year-end. They're not slowing down. China, 14 consecutive months of buying through December. 74,150,000 ounces of gold reserves. 2,305 tons. They add 30 to 40,000 ounces every single month, like clockwork. Brazil bought 11 tons in November alone. 43 tons over 3 months. Kazakhstan, Uzbekistan, India, Turkey, Azerbaijan, all active buyers. Central bank demand didn't stop because of the flash crash. Central bank demand is structural. It's policy, and it's accelerating. Now, one important note. There's no evidence that central banks bought the dip in the 48 to 72-hour window around the crash. Central banks don't move that fast. They don't chase intraday lows. Their buying programs are measured in months and quarters, not hours. But that doesn't matter, because the structural bid is still there. And when silver bounced 48% in 24 hours, it sent a clear signal to anyone paying attention. The floor is real, the demand is real, and the next leg up is inevitable. So where does that leave us? Gold at 49.02, silver at 112, both well off the lows, both consolidating after extreme volatility. But here's what's different now. The market has been cleansed. The weak hands are out. The stops have been hit. The leverage has been flushed. And the fundamentals? Stronger than ever. Samsung still needs 5,000 tons of silver cathodes. China still has export bans in place. Central banks are still buying gold every single month. The structural deficit in silver is still widening. Industrial demand is still growing. Nothing changed except the price. And when the price crashes 40% on technical selling, then bounces 50% in 24 hours, what does that tell you? It tells you the market knows where fair value is. And it's a lot higher than $76. I want to go back to something I said earlier, because this is important. Most channels are treating this like breaking news. Samsung deal announced. China bans exports. 5,000 tons. My audience knows that's old data. You've known about the Samsung deal for weeks. You've known about the China export restrictions. You've known about the structural deficit. The new story isn't Samsung. The new story is the flash crash and the V-shaped recovery. The new story is that the banks just showed their hand. They engineered a 40% shakeout. They liquidated $1.68 billion in leveraged positions. They cleared out 7.49% of gold open interest. And then silver bounced 50% in one day. That is not the behavior of a broken market. That is the behavior of a market that was artificially suppressed, realized it was mispriced, and violently corrected. And now the path to $150 silver is clear. Why 150? Let's do the math. Silver hit 121 at the peak. That was euphoria. That was leveraged retail chasing. That was unsustainable. Silver crashed to 76 at the bottom. That was panic. That was forced liquidation. That was also unsustainable. Silver is now at 112. That's consolidation. That's the market finding equilibrium after extreme volatility. But the fundamentals that took silver from $70 in early January to $121 at the peak haven't changed. The Samsung deal is still real. The China export ban is still in effect. The supply deficit is still structural. So if silver can hit 121 on hype and momentum, what happens when the weak hands are gone and the next wave of institutional buying comes in? You get 150, maybe higher. And gold? Gold barely moved off the lows. Gold is at 49.02. Gold's recovery has been anemic compared to silver. But that's actually bullish, because it means gold is coiling. It means gold hasn't released yet. And when gold starts moving, when it breaks back above 5,200 and takes out the 56.08 all-time high, that's when silver really goes. Because the gold to silver ratio is already compressing. It's at 43.6 to 1. If gold goes to 6,500 and the ratio holds at 43, silver goes to 151. If the ratio compresses further to 40 to 1, which is entirely possible given the supply-deficit dynamics, silver goes to 162. That's the math. That's the path. Now I want to address the people who sold. The people who panic sold at $80 or $90 or even at $100. The people who saw their portfolio drop 40% and couldn't handle it. I'm not here to shame you. I'm here to educate you. What you experienced on January 30th is what happens in every single bull market. Every single one. Go look at the gold bull market from 2001 to 2011. Gold went from $250 to $1,900. But along the way, it had corrections of 20%, 30%, even 40%. In 2008, gold crashed from $1,030 to $680. That's a 34% decline. People said the bull market was over. But gold went on to hit $1,900 3 years later. In Bitcoin, in 2017, Bitcoin went from $1,000 in January to $20,000 in December. But in September, it crashed from $5,200 to $3,200. 40%. People said it was a bubble. But Bitcoin went on to hit $20,000 3 months later. This is how bull markets work. They shake you out. They test your conviction. They separate the weak hands from the strong hands. And if you sold on January 30th, you just learned the most expensive lesson of your investing career. Don't chase tops. Don't use leverage you can't afford to lose. And don't panic sell into crashes orchestrated by the very institutions that want to buy your assets cheap. If you typed John AG Live OG in the comments, you already knew this. You've been with me long enough to understand the game. You didn't sell. You held. And some of you bought more. You are the winners in this market. You are the ones who will ride silver to 150. You are the ones who will look back at 76 as the opportunity of a lifetime. For everyone else, there's still time. Silver is at 112. That's 50% off the lows, but it's still 10% below the peak. Gold is at 49.02. That's 38% below the all-time high. The bull market is not over. The bull market just cleared out the dead weight. And now the path higher is clear. Let me leave you with this. January was the strongest month for silver since July 2020. Despite the crash, silver is still up 40 to 48% for the month. Gold is still up 13 to 20%. This is the strongest January for gold since 1980. The trend is intact. The fundamentals are intact. The central bank buying is intact. The industrial demand is intact. The only thing that changed was the price. And in a bull market, price pullbacks are gifts. If you've been watching this channel, you knew the crash was coming. I warned you in December. I told you not to buy the top. I told you they'd come for your stop losses. And when silver hit 76 and gold hit 48.86, you didn't panic. You didn't sell. You bought. That's why you're going to win. That's why you're going to be in the winner's circle when silver hits 150. Subscribe to this channel if you haven't already. Hit the notification bell, because the next leg up is starting now. And if you wait for confirmation, if you wait for silver to break 130 or 140 before you buy, you're going to miss it. The time to position is now. The weak hands are gone. The leverage is flushed. The banks have reloaded. The crash is over. The path to 150 is clear. And if you typed John AG Live OG, welcome to the winner's circle. This is John AG Live. I'll see you in the next one.